Eddie, good morning. Let's start with your thoughts then on oil. We just heard there about all the calls for going to $100 a barrel. Where do you think we're heading? Yeah,
look, Anthony made some really good points there. He, for instance, raised this, the idea that the market was made tight by the OPEC cuts, but also by the US driving season. We've got fairly steep backwardation, all of these things. $100, is a stone's throw away. So it would be a big surprise if we didn't at least touch there, right? I think there are many in the market which will position that way. But I also think that it is easy to overstate the importance of Cushing, right? Cushing isn't the direction in which US oil wants to flow right now. It wants to go to other centres. There are other centres, and when you go to Cushing, that's your delivery point of last resort. It's a mixture of grades that you get there. So people don't want to go via Cushing at the moment, and that's why stockpiles are coming. The market undoubtedly is tight. I just think that Cushing overstates the tightness in the market. I also think the backwardation in the market is interesting. It shows that right now there is, very strong demand for near-term oil, which is not a surprise coming out of driving season. But at the same time, backwardation tends to be a coincidental indicator, not a leading indicator. You tend to see, when you've got backwardation, near-term prices high, you tend to see oil coming out of storage, bringing prices down.
OK, that's interesting context, Eddie. We've seen, of course, yields up on the back of high oil. At least that's been a component in terms of the rally in yields and the sell-off in Treasury markets. When does that relationship, though, and that coalition between the two break down and it become more a story about recession risks rather than inflation? How much clarity do we have that? Was there the data telling us about when this becomes more of a recessionary impact rather than inflationary? Yeah,
drivers are already telling us that they in the US that they're worried about, filling up their cars and so on. Anyway, we're getting those German CPI numbers earlier that we already had some of earlier today. Those coming in quite cool. So we're seeing inflation coming back a little bit. And I think, that's going to feed through into yields at the moment. Now, we were expecting the German numbers to be slightly low, right? But talking to my colleagues on Markets Live, even that regional number that we had earlier was significantly lower than they had expected. So there's a real cooling of inflation, whether we could get across the...
OK, and still waiting for the open over on German bunds to see where that takes us. Close from the options market, futures market, of course. Let me ask you, I'm seeing headlines that involve JP Morgan and Whale, and that makes people nervous. What's the story here, Eddie?
Yeah, so look, we've got a lot of options expiring. There's just mechanical flows at the moment in the market that will lead people to be slightly shorter stocks over the next couple of days. And, the market's already been on the back foot. This will just exacerbate the problem.
OK, with that expiry approaching, a lot of nervousness around the size of it and what it does to those on the other side of that trade.